All right, so in this video, I'm going to talk a little bit about debt management ratios. So the first debt management ratio I'm going to talk about is the times interest earned ratio. So the times interest earned ratio is looking at the um, earnings before interest and tax relative to the interest expense. And notice the subscript for T here, indicating that it is at the same point in time. Okay. And notice that both of these are normally income statement items. So these are related to a period of time. So EBIT stands for earnings before interest and taxes over whatever period you're looking at, divided by the interest expense for whatever period you're looking at. So as of whatever set of financial statements you're examining. So basically, if I think about the typical income statement, we start off with sales minus cost of goods sold, get to gross profit minus various operating expenses. We get to EBIT, earnings before interest and taxes. Then I take off the interest, I get to earnings before taxes. So really what we're looking at here is the operating income. EBIT is also known as operating income. I'm looking at the operating income that I had available to pay the interest expenses. So what this is saying is how many times could I have paid my interest expense with my operating income? That's the basic idea here. So if you think about that, generally speaking, I would prefer somewhat higher in the sense that that would tend to mean that I could pay off my interest more times, and that means I'm probably less risk of not paying my interest and then going bankrupt. Now, having said that, though, could the ratio get too high? Well, possibly. I'll come back to that point in a moment. So let's go over the debt ratio now. So for the debt ratio is looking at liabilities over assets. So if you think about the basic accounting equation, assets equals liabilities plus owner's equity. So basically what we're doing is I'm taking the liabilities divided by assets. And what that's telling me is what proportion or percentage of my assets were financed by some form of liability. So if my debt ratio is 30%, that means 30% of my assets were paid for with some kind of debt or liability. I tend to use debt and liabilities pretty interchangeably. Some textbooks and sources will draw a little bit more of a distinction there, but I tend to use them pretty interchangeably for the most part. So if I had a debt ratio of 30%, 30% was financed with debt, 70% was financed with some sort of equity. So if you think about this, if I'm looking at this ratio, what's the lowest the debt ratio could be? Well, the lowest the debt ratio could be would be if we had zero liabilities, right? So there'd be zero debt ratio. What's the highest it could be? Well, the highest would be if all my assets are paid for with liabilities and I had a 100% debt ratio. Asterisk. Okay, so a little asterisk here. So here's the asterisk. It is technically possible, and it does occasionally happen, that a firm actually has more liabilities than assets. At which point, if you think about the accounting equation, if the liabilities are higher than the assets, that means in order for the accounting equation to be true, in order for assets equals liabilities plus owner's equity to be true, owner's equity would have to be negative. That is possible. Doesn't happen that often necessarily, but it can occur. So technically, it's possible for the debt ratio to get over 100%. But for the most part, for most of the time, what we're looking at, basically the debt ratio is neatly bounded between 0% and 100%. And it basically is interpretable as what percentage of my firm is paid for using some form of debt, basically. And that's the basic idea here. Now, with that in mind, could I have a debt ratio that's too high? In other words, could the company have too much debt? The obvious answer is, well, yeah. I mean, of course, the company can have so much debt it's about to go bankrupt. That could be true. Could a company have too little debt? So this is a little bit more of a nuanced situation, but I'm going to argue the answer is actually data and theory suggests yes. And the reason for that is this. It all kind of goes back to risk and return for the shareholders. So here's the idea. If a company borrows money from through bonds or whatever else, let's say 5%, and they reinvest it in things earning, say, 9%, where does the extra 4% go, right? So if they borrow at 5%, they invest in things getting 9%, where's the extra 4% go? And the answer is the 4% goes to the shareholders. So the shareholders are making money on money they didn't even contribute. Well, that sounds kind of good. And so what's the catch? The catch is because the company has debt, the company now has more risk of perhaps going bankrupt or having a bad financial situation. So basically, this turns into a question of risk and return. So when you take on debt, you increase the risk associated with the business, but we also potentially increase the return for the shareholders. So as long as I get enough extra return to justify taking on that risk, then shareholders may think, hey, take on the debt. I actually like this combination of risk and return better. And the shareholders may actually feel like they're benefiting. On the other hand, at some point, you could hit a level of debt that they take on more debt, the risk goes up a whole bunch, and the shareholders just don't feel like they got enough extra return for it. It's just too much risk and not enough extra return. It's just turning into an unfavorable combination of risk and return. So as a result of that, could we argue that a debt ratio could be too high? Absolutely, got way too much debt. Could it be too low? Yeah, that's probably true too, because maybe a better risk return trade-off could be had for shareholders by taking on some level of debt. And that brings us back to the times interest earned ratio for a moment. So for the times interest earned ratio, could the times interest earned ratio be too low? Right? Don't have enough operating income relative to my interest expense. Absolutely. And in fact, what if I had a negative operating income? What if EBIT is negative? If EBIT is negative, I actually can't even calculate the ratio. It doesn't even mean anything. The whole point behind the times interest earned is how much could my operating income contribute to paying my interest? Well, if I have an operating loss, it doesn't even mean anything. So basically what happens at that point is, well, I guess I guess the ratio is meaningless, right? And so what happens then is if the EBIT is negative, you can't even calculate the times interest earned. Now, having said that, does that mean the times interest earned doesn't matter? No, of course it matters. What it would mean is I can't calculate it, and I can't calculate it because it's awful, and basically it looks ugly. And so the issue there would be I can certainly interpret it and I can analyze it, even though I can't calculate it in that case, right? So a times interest earned ratio could definitely be too low. Could the times interest earned be too high? Well, if we go back to the debt ratio, could I have too little debt? Yes, possibly we could. And if I had too little debt, the times interest earned ratio might be really, really high because I don't have any debt. So it's maybe possible. I generally like a higher times interest earned ratio, but it's perhaps possible that it could get to the point where it's really too high, kind of because I have too little debt and I can get a better risk return trade-off for my shareholders by taking on a bit more debt. So you kind of have to look a little bit deeper into the situation to draw good quality conclusions here. Hopefully that makes sense, and hopefully that's kind of illuminating. To wrap things up, before I forget, one interesting point here as it relates to this. Interestingly, as to the extent that I'm using the total overall debt ratio, notice that's total liabilities, which include current liabilities and long-term liabilities. So here's a thought. What if a company has a vast amount of current liabilities and very few long-term liabilities? It's possible a firm could have a high debt ratio, and depending upon the nature of the liabilities, maybe also a high times interest earned. And I bring this up because that's actually a case that I encountered when analyzing a company at one point. And I got looking at their debt ratio, and it was quite high. And I was looking at the times interest earned, and it was sky high. And I was looking at that and trying to figure out, well, how exactly is that? They've got a load of debt, and yet their times interest earned is through the roof. Like, whoa, how is that possible? And then I started looking at that further and realized, well, they have like no interest expense, or at least very little. There's very little interest expense. How is that? And so I got looking at it and I realized, oh, almost all of the debt, or at least a vast proportion of the debt, was actually short-term debt. And basically, it was a current liability, and think like accounts payable and things like that. And as a result of being accounts payable that they aren't paying interest on, it was still counted as debt, but it didn't produce interest expense, and therefore it didn't affect the times interest earned. Side note, that also had a significant impact upon the liquidity ratios because of all those accounts payable and short-term current liabilities squashed the liquidity ratios, so the liquidity ratios were quite low. So that's when you kind of start to see that hopefully you're starting to see the connection between the different ratios. So all of a sudden, something we're talking about with the debt ratio meshes together with what's going on with liquidity ratios and what the interpretation of that would be. All right, hopefully this is starting to make sense. Hopefully this has been helpful. Thank you so much for watching and have a great day.